Oh no, oh no. Goldman now tells us that a lot of mutual funds want to see a DCF, or discounted cash flow, put in the sales memo. Oh boy. I prefer price to earnings or price to sales methodologies, but all right, fine. We'll go through this DCF, okay? And remember I told you before, there's so many independent variables when you do a DCF. That's a problem, right? And so what we're going to do is we're going to look at the price earnings analysis, which we've done, the price of sales, which we've done, and then the DCF. And we're going to take the target price for all three of those and triangulate what the average target price is for this IPO. Okay, so DCF is not as hard as you think it is, especially in tech, because cash flow and net income is basically the same thing. Okay, so let's do a quick DCF for our company, which is going public through Goldman Sachs. Okay, so we know that DCF, again, just like what we did with Microsoft, is the value of all future cash flows discounted. Okay, so we need to look at the cash flow from years 2020 to 2025. Remember, we're going public in 5 years, which is 2020. So first of all, we're going to calculate the WACC for our company, right? And remember, the WACC is the cost of capital, the weighted average cost of capital, which is the cost of equity plus the cost of debt. Because we're an awesome tech firm, there's no debt. Okay. So remember before, the cost of equity, or the interest rate we're going to use to discount our future cash flows, is quite simply the risk-free government rate plus the stock market return minus the risk-free rate times the beta. Okay. Remember with Microsoft, the beta was 0.78. It was less than 1 because Microsoft's a big, mature, slow-growing, slow-risk company, or low-risk company. What do you think our beta is going to be for our company, which is growing very, very fast, but is riskier? Will it be above 1 or below 1? Okay, we don't know yet, right? But the cost of equity we know is 1%. We're gonna multiply 11% times our beta. So what the heck is our beta? How do we find out? Where do we get that information from? It's not that hard. So we're gonna go to the internet and we're gonna find companies similar to us, okay? And this is all hypothetical, but there's an element of our company which is storage oriented. And so we're gonna get the beta of storage companies and take the average of them. So the first one we'll look up is a storage company called Western Digital, which makes a lot of hard drives that are in your computers. And the ticker is WDC. So we'll get the beta on that guy, right? We see the beta is 1.42. Okay, remember that number. Then we're going to get the beta on another company, which is similar to ours, called Seagate. And the ticker, I think, is STX. Okay, and that's another storage company that competes with Western Digital. Okay. And that storage company has a beta, hold on a second, sorry, of 2. Wow, that's high, okay? And then we look at another company called EMC, which we've all heard of, which I think Dell is kind of merging with now or something. And that has a beta of lower than Seagate because it's lower risk. And the beta there is about 1.3. Okay, so you take those 3 numbers, divide it by 3. Okay, and the average beta there is 1.57 or 1.58, whatever. And that's our beta. And it's higher than Microsoft's beta, our beta, because we're a riskier company, okay? So great. We've got a cost of equity. Our discount rate we're going to use is 18.34%. That is twice as much, almost, as Microsoft's was, because we are much riskier. So it costs us a lot more money to get access to capital. So we're going to use that as our discount rate, 18.34%. And so we know that DCF is basically the discounted cash flow of future streams. We've gone through this before, so I'll quickly go through these slides. And then if we just look at our spreadsheet, the forecast we made, we can get our net income over 5 years, right? And we can do our DCF over 5 years. I'm going to just breeze through these slides. We covered this when we did Microsoft. And then when we calculate our terminal value, we're going to divide it by 18.34, which is our interest rate, minus our growth rate. And because I'm more bullish on our company versus Microsoft, because we're earlier stage, I think our long-term growth rate is 5% versus Microsoft's 1%. And that's fair because we're a younger company and we're growing faster. Okay, and that's going to get us to a valuation of $5.4 billion, okay? $5.4 billion. Okay, and we're going to compare that valuation methodology to our other valuations that we came up with before, okay? We get an average upside of to a target price of $8 billion, okay?